This video is sponsored by Morning Brew. Click the link in the description below to sign up for their daily business newsletter today. Hello everyone, welcome to The Plain Bagel. I'm your host, Richard Coffin. We have a big update around the US-Chinese trade war this week, as it was announced on Sunday that the two countries, after meeting in Geneva, Switzerland, had reached a sort of agreement that's been described by the US as a trade deal, with the countries reducing their baseline tariffs by 115% for 90 days, with Trump going so far as to describe all this as a total reset in US-Chinese relations. Something that was pretty unexpected and has led to stocks rising higher, with the S&P 500 closing Monday up 3% and many tech and consumer discretionary stocks jumping in the high single-digit range. So as you can imagine, there's been quite the celebration and jubilation among investors here. But does this mark the end or the beginning of the end of the US-Chinese trade war? Has this really been a total reset as Trump has described? Well, as much as I hate being a party pooper, not really. In fact, with this announcement, all we've really seen is a walking back of the US-led escalation of the trade war back to essentially whatever tariffs both countries had pre-Liberation Day plus 10%. And what's interesting here is that outside of some loose promises to help crack down on fentanyl and open up trade to the US, there haven't really been any concessions from China here, and certainly nothing that's been concrete in terms of actually addressing the massive trade gap between the two countries. So while markets rising to be roughly flat year to date probably gives the impression that the worst is behind us and we've undone the economic harm of this trade war, the two countries are still very much in a tricky trade situation, with certain areas already seeing trade grind to a halt even before Liberation Day. And while we're seeing the advertised rates of now a 30% rate on Chinese goods into the US and 10% rate on US goods into China, the real effective tariff rates in both countries are currently still higher, with certain key products and industries still facing higher tariffs than many are being led to believe with this update. So today we're going to sift through the news to highlight what actually happened this past weekend, where we stand today, and what we can expect to happen from here, as we return to this channel's favorite topic of choice, tariffs. That's right, you thought I was pivoting away with that one TikTok review video I snuck in? No. We're tariff channel now. But let's start at the beginning. What actually happened this past weekend? Well, leading up to the Saturday, we saw the US hinting at the fact that trade tensions with China were seemingly cooling down. With outside of reports of dialogue between the two countries after communication was seemingly not happening earlier on, we had the US announce a trade deal with the United Kingdom, a first sort of breakthrough in the global trade front the US has kind of initiated with everyone, whereby the two countries agreed to maintain a 10% baseline tariff, but the UK was now allowed to export 100,000 cars to the United States at a 10% tariff rate, which is an exception to the flat 25% rate applied to other countries, and the country won't have to pay the additional steel and aluminum tariffs faced by other countries, which, while perhaps not groundbreaking given that the UK only represents roughly 2% of US imports and there are still tariffs with this deal, it was still a step in the right direction, showing that Trump was willing to at least give some exceptions to the high levies that have been imposed. So when US Treasury Secretary Scott Bessent and Chief Trade Representative Jamieson Greer met in Geneva with China's Vice Premier He Lifeng, people had fairly high hopes. But as we saw, the announcement proved even better than expected, with Scott Bessent describing the communication as constructive and the White House announcing on Sunday that the two countries had tentatively reached a supposed trade deal, with a joint statement from the two countries being issued on Monday highlighting that A, the two countries recognized the importance of a sustainable, long-term, and mutually beneficial economic and trade relationship, and B, each country would roll back the tariffs imposed April 2nd and onwards in favor of a baseline 10% tariff for 90 days. As for the details of what the agreement accomplishes, as mentioned, it effectively brings both countries back to pre-Liberation Day. Americans are rescinding their liberation to try and bolster a stronger trade relation with China here. If you recall, on Liberation Day, Trump imposed a 34% reciprocal tariff on China. China responded with their own 34% tariff. The US added 50% to theirs. China added 50% to their own. The US went to 145%. China went to 125%. And now we've seen it all, mostly walked back for seemingly no tangible concessions. Art of the deal. Joking aside, we don't know what concessions were agreed to in principle here, but the confirmed details is that both countries are being brought back to a baseline tariff rate of 10%, with the US maintaining an additional 20% tariff that it had charged before April 2nd. The fentanyl tariff that was initially imposed in February at 10% and increased to 20% in March, given that China is one of the primary sources of fentanyl and its components. So there is an argument there. Not so much for Canada, but that's aside from the point. We're not talking about us here. Now, China has also agreed to remove its non-tariff countermeasures that were taken after April 2nd, which includes softening the export controls on rare earths, which are used in the US as a component for high-tech products, and the addition of certain firms to a list of companies that face trade sanctions or export controls. And it was highlighted by President Trump that China has agreed to stop sending fentanyl to the United States, which is awfully nice of them. Now, as mentioned, markets reacted pretty favorably to all this news. Stocks, especially in the tech space and consumer discretionary areas, jumped by a good amount. The US dollar index rose 1.4%, and even defensive positions like gold and treasuries saw a sell-off, which is partly why we saw yields rising, as investors were selling bonds and cycling back into riskier positions. But while a 30% tariff on Chinese goods and a 10% tariff on US goods may not sound all that bad, there are a few things worth noting here. For one, while markets are celebrating all this, 30% is still a very high tariff rate for America's third largest trading partner. I know it feels like a breath of fresh air compared to the triple digits we were dealing with, but it still brings the average US tariff rate to around 18%, the highest level it's been in 90 years. And two, these tariffs are in addition to other levies on US and Chinese goods respectively, that are staying in place because they were introduced prior to Liberation Day. On the US side, the country is still maintaining its Section 232 tariffs, which is that 25% rate applied to all imports of steel, aluminum, and auto parts, with that one exclusion for the United Kingdom now. And we still have the Section 301 tariffs, which apply to a slew of specific products coming from China that the US deems as facing unfair trade practices, such as solar cells, which from China face an additional tariff of 50%. So in that case, we still have a very high tariff rate of 80%, and there are many other product categories that will face higher effective rates than that advertised 30%. The US is also maintaining any sort of most favored nation tariffs, meaning that any broad tariff applied to all members of the World Trade Organization, excluding any sort of explicit trade deal, will also apply to China here. And what's really flown under the radar here is that the country will still be maintaining its cheap imports tax, whereby it applies either a 54% tariff or $100 per parcel for packages that are valued below $800, which will have a pretty meaningful impact on cheap imports from China and companies like Shein and Temu. And with it being estimated that the US imported roughly $46 billion worth of these types of goods from China in 2024, representing roughly a tenth of total US imports from China, you can see that tariff here will have a meaningful impact. So while we did see this tax reduced from its post-Liberation Day level of 120%, it's still very high for goods that previously faced no duties under the de minimis exemption, which during this trade war has since been closed. So as you can see, there's still a lot of Chinese products that will face even higher rates than that advertised 30% tariff. And even on China's side, while they've agreed to reverse trade actions taken after April 4th, they too have additional tariffs that seemingly will still be in effect. For example, during the first leg of this trade war pre-Liberation Day, we saw China impose tariff rates of 10 to 15% on coal, crude oil, liquid natural gas, agricultural machinery, and importantly, agricultural products from the United States, with that last category being important given that China buys roughly a fifth of America's total agricultural product exports. So with this rate seemingly still in effect and being additive to that baseline 10% tariff, we still have pretty meaningful rates on US-Chinese trade here. In fact, US exports of liquefied natural gas to China have already ground to a halt since February, and there currently aren't any exports of crude oil scheduled for the month of May, demonstrating how uneconomic even these lower rates remain. And while April inflation data did come in cooler than expected, it's likely we'll see the full impact of tariff policy on inflation figures in the coming months. And unfortunately, in the previous iteration of this trade war back in 2018, we didn't see exporters really lower their price, with US importers bearing the brunt of this new tax burden. And while naturally the hope with all these tariffs has been that it will onshore manufacturing back into the United States, and indeed we have seen some countries committing to investing further into the country, albeit some of the amounts seeming fairly dubious in terms of their scale, so far we haven't seen the widespread sort of onshoring of production that many would have hoped for. Until the situation stabilizes, it's unlikely that we'll see that. Companies don't face much incentive to invest in the United States when the trade policy has proven so volatile. So while certainly this recent update has been a positive for global trade, it also reflects the point that this has been an incredibly dynamic situation, which makes for a very difficult environment for companies to operate. And in addition to inflation, many economists still expect a negative net impact on economic growth as a result of the current trade situation, even if it's a lesser impact than we would have otherwise seen with triple-digit tariffs. Now, of course, everything we've discussed so far is based on the publicly disclosed details of these conversations over the weekend. And while we don't yet have a signed agreement here, there is naturally the chance that we have some softer agreements that were agreed to, again, in principle during the weekend. For example, Trump has stated that China has agreed to open itself up to American business, which has long been a point of contention Trump has had with China. Back in 2018, when he first started a trade war with China, it ended with an agreement for China to restructure its markets and purchase $200 billion more of US goods. But the trade gap between the two countries remains quite large, and the country fell well short of that target, with the agreement largely being viewed today as a failure. Now, on the positive side of things, interestingly, this 90-day pause is expected to lead to a surge in Chinese imports as companies try to build up their inventories prior to that 90-day tariff deadline. And there is still a lot of optimism that this is, again, at least a step in the right direction, that Trump has shown a willingness to, 180 on this hardline approach to trade here. We moved away from the messaging that tariffs are actually good for the US economy and could even replace income tax, that the US doesn't need any other country, to a joint statement from the two countries highlighting just how important trade between China and the US really is. And it does seem like markets don't really believe that Trump is intent on keeping high tariffs here, with valuations remaining fairly extended even with the tariffs currently in place and the pauses for all the higher reciprocal tariffs all set to expire by August. And while the Trump administration has highlighted that they don't expect things to return to the high triple-digit tariffs we had before, as we've shown, even lower double-digit tariffs in certain industries can still be enough to ultimately inhibit trade. So while this is certainly a positive update with the global trade war that we find ourselves in, to see a fundamental improvement here, we still need to see more explicit trade deal agreements signed by countries and a demonstration from both the US and China that they will stay true to their words with these trade agreements, which, if history is any precedent, could prove tricky. Nonetheless, that's where we are today, and we'll just have to wait and see how things play out. Thanks for watching. Before I sign off, if you're looking for more up-to-date information on these type of events as they play out, rather than a video that happens 5 days after the news comes out, which I'm trying my best here, but you can check out today's sponsor, Morning Brew, a business, finance, economics, tech newsletter. It really covers all that stuff that if you're watching this channel, you're probably a nerd about. Morning Brew is a newsletter that's sent out 7 days a week right to your inbox to cover the daily happenings and keep you posted on important stories. For example, they've had great coverage of the recent China-US updates, but have also covered other interesting areas, such as the implementation this past week of the new anti-bait and switch pricing rules from the FTC in the United States, which now requires businesses selling live event tickets and short-term lodging to be more upfront with the total cost of their services and why consumers are paying additional surcharges to begin with. A glimmer of positive news in the current environment. And what's great about Morning Brew is that it's an easy read. It's genuinely one of the first things I read every morning. The writing is light, informative, and witty, so you can learn something and have fun doing it. But the best part by far is that they're completely free. So if you'd like to check them out yourself, you can use the link in the description to sign up. It's a very quick process, takes under a minute to put in the details to start receiving the newsletter, so you can start reading today. So thank you, Morning Brew, and thanks you guys for joining today. If you like this video, please do make sure to like, subscribe, all that good stuff. It just helps the channel tremendously. And let me know your thoughts on the US-Chinese trade war. Where do you see things going from here? Thanks again for joining, and as always, be safe out there.